Most investors spend years learning exactly what to buy, but they spend zero time deciding when they will sell. That's backwards. Buying simply gets you into a position, but selling is what preserves your capital, protects your income, and repositions your wealth before the market changes. As income hunters, we know how to track the deepest, fastest flowing financial currents. That's the easy part. The real challenge is knowing exactly when to exit. Today, we pull back the curtain on emotional investing to map out a clinical sequential workflow I call the three flag exit system. Hello, my name is Daniel Young, and this is Adapted Perspective. Every week, we separate currents from noise and opportunity from fear using an income focused strategy and closed end funds. It isn't polished, it isn't scripted, and it's definitely not herd thinking. We don't chase headlines, we navigate markets. Now, let me be clear. I am not a financial advisor or a fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets durable cash flow, even when that means taking a different course. In this Sunday briefing, we break down how to remove emotion from your portfolio entirely, tracking our active closed end fund snapshot and revealing how a visual system of yellow, orange, and red flags dictates exactly how to protect your family's financial legacy. So let's look at the data. Last week, we talked about exit strategies. This week, I want to make the conversation practical. Most investors spend years learning what to buy. Very few spend time deciding when they'll sell. And that's why every investment deserves an exit strategy before it's ever purchased. If you wait until emotions show up, you've already waited too long. So today, I want to show you the workflow I use. It's simple, sequential, and completely unemotional. I call it the three flag exit system. So three flags: yellow, orange, red. Flag one, yellow. Yellow means pay attention. The financial current is still healthy. The fund is still doing its job, but something inside the fund deserves a closer look. Maybe management is drifting from its mandate, or destructive return of capital begins appearing, or internal performance begins slipping. Nothing changes yet, so long as the current is still flowing. Simply move the fund onto a weekly watch list and keep going. Flag two, orange. Orange means proceed with caution. It's no longer just a fund issue. Now the current itself is beginning to slow, and capital is beginning to leave the entire sector. At this point, I stop adding new money. I pause any reinvestments and begin identifying where my next allocation will eventually go. Orange isn't a sell signal, it's preparation. And flag three, red. Red means one thing: your investment thesis is broken because the macro picture has fundamentally changed. Maybe the macro current shifted. Maybe inflation reversed and rates are now moving against your thesis. Or maybe the fund entered a structural decline from which it isn't likely to recover. Whatever the reason, the original reason for owning the fund no longer exists. That's when I sell. It's a clear, designated cause and effect. No emotion, no second guessing or hoping, no negotiating with myself. The thesis changed and the portfolio changes in response. Now, we're not necessarily applying those flags this week, but I want you to keep the workflow in mind as we move into today's closed end fund snapshot, because every new position deserves both an entrance and an exit strategy. And of the snapshot, the market itself hasn't really changed. Our strongest financial currents remain bonds and select bond proxies, real estate, end-to-end energy, and the technology family tree. So let's look at the funds positioned inside those currents while also asking a different question. If I bought the fund today, or in this case Monday, tomorrow, what would eventually convince me to sell it? So let me get to that list and we can continue this conversation. So This is the final 10 pack, and I've got several things highlighted so I make sure I cover them because my notes are not on this page. This at the top is question mark because it's true. I don't know how much money I have at my disposal, which means I'm not buying tomorrow. I bought 3 weeks ago. Um, if I bought on schedule, it would be next week. Um, so let me back up. So the list itself is sorted the same and wonderful. Um, Everything is a target based on the fund's individual discount compared to its historical discount. They all pay monthly. They all pay 9% except for two funds, which RFI is unleveraged. It just pays a flat, steady, amazing, ongoing dividend. And then PDT is a rising dividend, or I believe is a rising dividend. It's recently hiked its dividend, and with hopeful lower rates coming, I think it would raise its dividend again. So that leaves us a 10 pack. And I don't know about you, but even if my dividends are paid and in my account, it's not like I have all the money in the world. So I'm not about to pretend that I've got 10 grand or 20 grand to buy funds with this month. And that would allow me to cover every single fund on the list. I only have so much money. You only have so much money. And because we only have so much money, we have to filter the list. Now, this is a filtered list. It started with 30 some odd funds, 40 some odd funds. So all of these funds currently exist in the top four currents, but how can we filter the list even further? Because when we only have so much money, we need to be hyper selective and optimize our investment. So the truncation of funds, it's a hyper selection and then further designated based on where that further filtering comes into place. Yes, the final sort is based on the 1 year NAV data, but in doing that, I noticed a blind spot this week. So it's 10 funds. They exist in relatively different currents for the most part. These five exist in the same current. They're all bonds. You could argue BRW exists in the same current, but I think it's more private credit. You could argue HGLB is getting weighed down by bonds because they do have a small bond component, although I think their decrease is more tied to Fermi than the bond sector. But regardless, if you look at just the 1 year NAV data and we track a fund's overall 1 year net asset value today as compared to a year ago, BRW, this five pack, BRW and this five pack are all below value based on that data. IGR is close to level, HGLB is close to level, RFI is higher, PDT is higher. RQI was on the list last week, but its discount has since disappeared and doesn't meet the threshold or the requirement anymore. So it's really just two funds that have higher NAV today than they did a year ago, two funds that are kind of on par, and then six funds that aren't. However, if we're looking for maybe the disparity or the incongruency in NAV data, and we're using it to further filter the funds, it's not like we're always comparing apples to apples, comparing bonds to real estate or bonds to tech or bonds to energy isn't quite the same thing. So it that's hard, but it's harder still for me to take a deeper look and say that PIMCO and Double Line, who are they are the top tiers of the bond market. It's really hard for me to say that because their 1 year NAV average has dipped, or their 1 year NAV value has dipped, that both managers, both teams are experiencing the same managerial disconnect at the same exact time. And I want to talk about this more next week, but it's almost like filtering filtering like using nav as the final filter isn't quite the final filter. It makes it easier in the sense that if we just take it at face value, RFI and PDT have the two greatest disparities between current nav price and price. And it also reveals the greatest disparity between their gains in NAV versus others not gains in NAV. But it also makes the list harder because PIMCO and DoubleLine aren't experiencing drift. Their managers are top tier. It's not a structural issue. It's not a structural issue causing their portfolios to lag. It's really the symptoms of the market at large. With the Federal Reserve keeping rates higher for longer, or in this case, higher for longer and now stagnant for longer, and even with the new chair, rates are still the same. So rates are now stagnant for longer. That's weighing down on their bond portfolios, and they're feeling the tension of that, feeling the compression of that. So if we trend the way I believe we're going, if we trend toward lowering rates, the Federal Reserve finds any sort of data it can find to justify rates, not manufacturing data, but with a strong economy, strong oil production, things I've listed in the past, with a strong economy that's increasing in speed, we need lower rates to further fuel the expansion of everything we're seeing at home. Lower rates would act like a coil. Lower rates would accelerate the growth of those five companies. Kind of, if we're compressing a spring currently, right? If we're compressing a spring, lower rates would free the spring and allow it to expand. So all of those things would uncoil and expand rapidly. So it's not simply that the 1 year NAV sorts out six funds off the list. It just helps us identify things a little bit better at the surface, maybe on a one-off comparison, just on very superficial comparisons. But in reality, all of these funds are still viable actions as they exist inside the current funds. It just comes down to what you see as the best overall investment for your money and how much money you really have. So it's how much money do you really have? What's the best buy for you? Maybe what's the best package you can put together for you, for yourself? And as they relate to the four top currents, it's bonds, real estate, end-to-end energy, and technology. So it's really, I don't want to sound wishy-washy. It's really up to you and doing what's best for you. For me, I'm not buying tomorrow. I've still got more portfolio to update. What I can share is this. So as the exit I haven't mapped out the exit strategies on this one page. I have mapped out the exit strategies inside my Roth account. And this is everything except for my account information. But as all of these funds exist inside my Roth, I have the overall ticker information that I've started to compile from the CEF master. Then as of today, I've added exit strategies for the Roth account. The funds that are in crossover, like the funds that I share between Roth and the cash brokerage, have these same things. The isolated funds that are specific to the cash brokerage are not mapped in yet, but my goal is to then map them in by the end of this week. So this is the exit strategy framework for BRW, but it's also the overall framework. It's that three-tiered system applied to every fund. And then at the very end, the KISS principle, keep it simple, of further compressing that information into two things or three things to really look for in the market so that when or if that happens, it's an automatic sell signal and not a arguing with myself or negotiating with myself or second guessing myself or anything. It's just if this, then that, done. So take it for what you want. And if you really want the specific system, I mean, uh, I guess you could freeze the frame and type it all out and use it. But well, that's up to you. So as it relates to this week, think of how the exit strategy applies to each of these funds. And then before you buy the fund, consider why you're getting into it and then why you would leave it. And then at some point, add a definitive exit strategy to your portfolio. So I'll leave you with this. Every fund eventually leaves your portfolio. The only questions are when it leaves and if it leaves on your terms. And that's why every investment deserves an exit strategy before you ever buy it. And the goal isn't predicting the future, timing every top, or guessing every market turn. It's much simpler than that. We just need to learn to recognize change and correctly respond to it. Yellow tells us what to watch, orange tells us to prepare, and red tells us to act. And when the decisions are made ahead of time, emotion loses its seat at the table. You're no longer reacting, you're just following a process. And that's what I expect from a fellow captain. So that's all I have for the week. Have a great week, and I will see y'all next Sunday. So I have things to do this week. I know you do as well. So whatever you have to do, I wish you success. I wish you progress. Yeah, and I wish you forward progress in your overall journey. So by all means, leave me a comment, and otherwise, I will see y'all next week. Have a great week, everybody. Bye bye.